Relative Strength Index. The relative strength index is an indicator that lies between 0 and 100, and it is used to tell us when a security is overbought or oversold. Alright? So like we said, when the RSI is very high, okay, so it's close to 100, that means it's overbought. When the RSI is low, that it is closer to 0, then it is oversold. So it's fairly simple, and we want to sell when a security is overbought, and we want to buy when a security is oversold. So let's first go through the calculation of the RSI. The RSI, the first thing we do is that we calculate the upward or downward change for each period. So for each period, either has an up or down change, right? So in each period, either the price went up or the price went down on a particular day. So if the price went up on a particular day, then the value of the up period would be today's price minus yesterday's price, PT minus 1, and the down value would be 0, alright, because the price didn't go down on that day. So far so good. If we have a down day, then the value of the down period is yesterday's price minus today's price, and this ensures that it's a positive value, right, because we're taking yesterday's price was higher than today's price, so that down will be positive, and the up value is 0 whenever we have a down period. The next thing we do is calculate the RS, which is the relative strength, whereby we take the exponential moving average of the up periods over n number of days. So the n refers to the number of days of our EMA, so this could be 12 day, 15 day. We take the EMA of the up period moves, and we take the EMA of the down period moves, and we take the EMA of the up divided by the EMA of the down. That gives us our relative strength. Finally, we convert this into an indicator between 0 and 100 by getting the relative strength index, which is 100 minus 100 over 1 plus the relative strength. And this is how we calculate the relative strength index. Relative strength index. How exactly does the relative strength index works? Well, what we do is that we're using really the number of up moves or down moves. So we're looking at when securities go up, how often they go up, relative to how often they go down, and we're taking an exponential moving average of the up and down moves to make it smooth, okay? So we're using the number of up and down moves as well as their magnitude, right? We're looking at how much they moved up or down, right? And that's where the up calculation of PT minus 1, so the magnitude as well. We're using the number and the magnitude in order to determine whether a security is overbought or oversold. Now let's talk about a trading strategy using the relative strength index, and this is a very common trading strategy. When the relative strength index is low or below 30, that's an indication that it's oversold. So remember, the relative strength index is between 0 and 100. When the relative strength index is below 30, that's oversold. That's a buy signal. When the relative strength index is above 70, that means it is overbought, and that is a sell signal. Right? So when the RSI is low, we should buy. When the RSI is high, we should low. Now, 30 and 70 are common thresholds that are used most of the time. We can pick our own. We can do 20 for oversold and 80 for overbought if we wanted to. We could do 40 and 60. But the most common ones to use are 30 and 70. And the other thing we need to do is pick the number of days of moving average we want to do. Now, when does the RSI work? Well, again, because this is an indicator that focuses on overbought or oversold conditions, the RSI works best when markets are not trending. Alright, so if markets are oscillating, moving up and down, or they're in a weak trend, then the RSI works well. However, the RSI tends to work poorly if the market is in a strong trend. Alright, as is the case with the rate of change indicators we discussed earlier. Now what we'll do is we'll go into Yahoo Finance and we'll take a look at the RSI graphically and after that we'll look at it in Excel. Relative Strength Index. Now here we are back in Yahoo Finance with the same chart that we had before. The first thing I'm going to do is remove this rate of change indicator so we can look at the relative strength index. And it's here in technical indicators, you'll see RSI, relative strength index. So I'll click on this and it has set the default period to 14, which is the number of days of moving average. So we do need to set that one parameter, the number of days. So we'll keep it at 14. Let's draw it here. Alright, and now we can see this relative strength index at the bottom of our screen. And you can see that this lies between 0 and 100. You can see the scale over here on your right. And what we're going to do is follow that simple trading strategy where we buy when the RSI is below 30 and we sell when it goes above 70. So how would that do? Well, let's look at it from a graphical perspective. Around here, the relative strength index is very low. Okay, it falls to about 30 over here. So at this point, we would be buying, and this would actually result in a few losses, but it would recover because the RSI would start to go up again and the price would go up. So depending on how long we held that, then as you can see at this point, the RSI is kind of around 60, so that would imply no real positions. Then we go on over here, and now we get a relative strength value here at about 70, right? So this tells us that the asset is now overbought, so this would be a sell situation. And this would end up doing reasonably well because the price does end up falling quite substantially at this point over here. And now down here, we would now have a buy situation. And because the RSI is very, very close to 0 at this point actually. And you can see the price tends to rebound from here. Down here again, we have, this time relative strength index is not at 30, so we wouldn't take a long position. So we would actually miss out this trend in the relative strength index. And now if we go up here, we'll see the RSI very high at 87. And this would indicate us to sell. And we could see that that would actually do quite poorly because the market keeps trending upwards. And the RSI actually stays quite high. So here's an example where the RSI is not really working when the market is trending. So this portion here is a very, very simple market trending upward. And the RSI is kind of giving us a false signal. So this is kind of important to be aware of, that the RSI does not tend to work well when markets are trending a lot. So this is a strong trend, right? Then here again, we may have some short positions. Finally, it would make some profit here. And then if we go all the way to the end here, again, a long position here because it was oversold would make money as the price went up afterwards. So you can see that on this graph, the relative strength index is sort of mixed. It doesn't really perform too well. Now what we'll do is take a look at this in Excel and we'll execute a full trading strategy with it. Relative strength index. Now here we are back in Excel, and what we're going to do now is calculate the relative strength index, and we'll also do a simulation of the trading strategy whereby we buy when it's below 30 and sell when it's above 70. So let's go into the RSI tab over here. Again, we have the same price series as before. This is the value of the Nifty index. Now there are a few steps to calculating the relative strength index, so follow along with me. We'll do them one by one. The first thing we need to do is calculate all the up moves, and then we need to calculate also all the down moves. Alright, so first I want to just get an idea of whether the price went up or not. Okay, so first I can just do the change, right? So I can just look at how much did the price change by. And this will simply be the recent price minus the previous day's price. And here we'll have some positives and some negatives. So now I want to separate these into the up or down moves. And I need to make sure that they're all positive, right? So up move should all have positive numbers. Down move should also have positive numbers because down move is actually it's a reverse sign, right? PT minus 1 minus PT. So let's first calculate the up moves. So this is the up moves. I'll just call it up. The up moves, what we want is that when the price went up, we want to display the movement. When the price went down, we want it to say 0. Okay? So all I need to do is have an if function here. So if that is greater than 0, then give me this value itself. Otherwise, give me 0. Okay? And now we can see we only have the up moves over here. The next thing I want to do is the down moves. And I'm going to follow the similar formula, except it'll be the other way around. So this will be back to C. And this time it will be if C2 is less than 0, then I want C2, but I want the sign reversed, right? I don't want this to be a negative. So I'll say, give me negative of that. And now I have all the down moves. So here I have the up moves and the down moves, and these are now in absolute value terms because we want them all to be positive so that we can do our EMAs and calculate the relative strength. Okay, so now we've calculated the up and the down. The next thing I want to do is calculate the EMAs of the up series and the EMA of the down series. And we'll use 14 days, which is what we saw in the chart, just to keep it consistent. And that's kind of the default, that's what we tend to use, but you can use different ones if you want. So this is going to be the EMA of up and 14. Okay, so let's go all the way down here. Copy this one across. Alright, we want to copy that as a value actually. So I'm just going to write it in 2115. Yep. So now the EMA is going to be equal to the normal EMA formula that we've been working with, which is the price minus the previous day's EMA times 2 divided by the number of days, which in this case will be 14 plus 1, okay, plus the previous day's EMA, and that we have that over there. And this I take it all the way up there. Okay, and you can see this does fluctuate quite a lot, and that's fine. Now I want the EMA of the down moves and the 14-day moving average, the 14-day EMA of the down moves. So that's going to be EMA D14. And we'll follow the same formula, so let that first value be 0. Then I can just copy this formula across. It should have the right numbers because it's a column away. Yep, so it's this value here minus that one times 2 divided by 14 plus 1 plus that day. That's fine. And then I copy this all the way up. And now I have the EMA of the up moves and I have the EMA of the down moves. Alright, the next step is the relative strength. The relative strength is simply equal to the EMA of the up moves divided by the EMA of the down moves. It's just going to be that divided by that. And this I can copy all the way down. Okay? And we can see this relative strength varies a lot, except for this first value here we don't need. And you can ignore these values down at the bottom because they obviously, the EMAs are not fully calculated at these points. And now I can calculate the relative strength index. The relative strength index, the formula for it is as follows. So we'll take 100 minus 100 divided by 1 plus the relative strength. And this gives me my RSI value. So I'll copy this all the way down, and you can see now this is between 0 and 100. So let's actually do a trading strategy and see how it would perform. So what I would like to do now is I'm going to not use values from 2005 onwards. So let's just not ignore those. I want to take them out, but we'll just ignore them. So let's say I want to have a trading strategy whereby if the RSI is less than 30, then I want to buy. If the RSI is greater than 70, then I would like to sell. Okay? So how would it work? Then, well, my position would work as follows. So I would say, so for long positions, so let me divide these into long and short position. For long position, I would say if the RSI is less than 30, then give me a 1, otherwise give me a 0, and this will tell me when I should take my long positions, and we can see there's some long positions over here. And for short positions, I will say that if the RSI is greater than 70, then I want a -1 or a short position, otherwise I want a 0. And then these -1s, you can see some here, give me my short positions. Now I'm not going to go on and actually calculate the returns from this strategy. The reason being is that the RSI is really only used to determine when to enter a position. It's not a one that you can use to also determine when to exit. So with like the moving averages, for example, you would have a position all the time, right? If it was one was above the other, you'd be long, and otherwise you'd be short. So it was always one or the other. So we could calculate the overall returns. But this is just telling us signals of when to buy and when to sell. So we would need to determine a holding period. We could set a fixed holding period, for example, that we buy a position and sell it for and hold it for a certain number of days. Or we could ask something that when the RSI goes up to a certain value, we get rid of it. Let's say when the RSI goes to 50, then we get rid of the position. So we'd have to create our own exit rule for this strategy. But for now, what we can see is that the RSI does provide a fairly intuitive. The calculation is a little bit complex. We have a few steps to do. So let's just review. We calculated the up moves as either when there was an up move, otherwise a 0. We did the down moves either when there was a down move or a 0. Then we did the EMAs of the up moves and the down moves. Then we calculated the relative strength by taking the up move EMA of the up moves divided by the EMA of the down moves, and then we converted this into an index that had a value between 0 and 100. And then of course our trading strategy here is that if the RSI is below 30, we go long. If the RSI is above 70, then we go short. All right, and that's the strategy we followed over here. So that concludes now what we're going to talk about for RSI. All right, now this again is a very, very common indicator that you'll see a lot. So now you know exactly what it is and exactly how it works. And it's a very good indicator. It actually is one of the better indicators to tell us when something is overbought or oversold. But just be aware that it tends to not work very well if markets are trending a lot. As we saw on the chart, when the market was trending a lot, the RSI didn't really help us. So that's really the main thing to be aware of when we're talking about the relative strength index.